Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we interview Chaikin Analytics founder Marc Chaikin.
And today Corey and I will talk about a zany cast of characters, including Jerome Powell, Adam Neumann, maybe Sam Bankman-Fried, anybody else we can think of?
And remember, if you want to ask us a question or tell us what's on your mind, email us at feedback@investorhour.com.
That and more right now on the Stansberry Investor Hour. A zany cast of characters. Who do you like first? I kind of like Adam Neumann, but Jay Powell he came up big, recently. So,
yeah, that's quite the crew. Let's go Adam Neumann for 100, Dan.
Yeah, Adam Neumann.
Because we talk about Jerome Powell all the time.
We really do.
We will again today, I suppose, but Adam Neumann is a little more timely, right?
Just a little, yeah. So for anybody who doesn't know, Adam Neumann is the co-founder and the former CEO and chairman of WeWork, the co-working company that leases office buildings for 10 or 20 years and then rents the space out to tenants, as few as like one tenant, could rent a desk in these things. It's called co-working, but for like as little as a month. So, they are taking on the long exposure and trying to make a business on the short end of that. And they declared bankruptcy last week, as we thought they would. And I had written about this previously, that there were murmurings in the press that said they were preparing a bankruptcy filing, probably about a couple of years after they should have anyway. And they finally did it. No, none of us are shocked, are we?
No, I was surprised they hadn't gone bankrupt before. So I've been ready. And we talked about last week, maybe this is a little sign of the trouble in commercial real estate coming in general, but we covered that already. So go ahead. Yeah.
Right. So the thing that grabs me here, there's two things that grab me. I suppose it ultimately boils down to one, and it's just the craziness of Adam Neumann. But he came out with a statement at the same time that WeWork had filed bankruptcy. And I have to read it. It's very short, but it's incredible. It says, as the co-founder of WeWork, who spent a decade building the business with an amazing team of mission-driven people, the company's anticipated bankruptcy filing is disappointing. It has been challenging for me to watch from the sidelines since 2019 as WeWork has failed to take advantage of a product that is more relevant today than ever before. I believe that with the right strategy and team, a reorganization will enable WeWork to emerge successfully.
Sounds like a lot of bankruptcy filings. Yeah.
Yeah, actually, you'd think bankruptcy, he would say, we made some mistakes and we were too levered and we did this and we did that and I made mistakes as a CEO. But there's none of that. There's I'm really disappointed in the, he left this big mess. The thing never did anything but log operating losses, and they went bankrupt with $19 billion in liabilities and $15 billion in assets. And the assets, I bet, are shaky. And liabilities are solid, assets are shaky. And it's still all hubris. It's still, he's looking down his nose at the mess he left to other people. And then they of course, had to deal with COVID. He didn't have to do that. And he got out. Right. This is the thing that really kills me here. Everybody's wiped out. And, they'll have to negotiate with the creditors and bondholders and stuff. And he got out with, at the time when they kicked him out in 2019, he was worth about $2.3 billion. Now it's only about $1.7 billion. And some of it was cash. He cashed out big, like at least, I can account for close to $1 billion in cash at least. It's amazing. The guy's still a billionaire. That's just
good move by him on that part, I guess.
Respect, yes.
It's got a Sam Bankman-esque feel to this. Sam Bankman-Fried-esque hubris / I don't know, kicking cans down the road sort of thing and hoping you get away with it sort of feel.
Which he sort of did.
A little bit. Yeah, right. I mean, yeah. Except he's not serving jail time, most likely. He's just got to probably move on to, when companies got to this point, I feel like, these guys or girls go away for out of the spotlight for a couple of years, and then somehow they reemerge 5 or 10 years later doing something else, and they get a second chance usually. So maybe we can start thinking about what Adam Newman's next venture might be.
Okay, just one more thing on this, and then we can move on to Jay Powell. I just have to say this. This is where I've wound up on Adam Newman up to this point. You and I know entrepreneurs. We know people who get out of bed every morning and think about nothing but the excellence of the enterprise, of their brainchild, the thing they live for. And that is a very specific and seemingly all-consuming mindset. I think we're all familiar. We could all name, Steve Jobs and Mark Zuckerberg, and you could name it, even Warren Buffett, just all consuming. And Adam Newman cashed out in clever ways. One of the things he did was borrow at the time he was ousted from WeWork in 2019. He borrowed $432 million from SoftBank, the biggest shareholder. But instead of having to pay it back in cash, the agreement was he would just pay it back in shares, whatever their value, according to an article by Matt Levine from Bloomberg. And I mean, it's just a share sale, right? He just sold 432 million in shares, and now they're kind of worthless. Yeah. But really, getting back to that mindset, so there was all these different ways that he cashed out. And I think if you cash out really well like that, you're kind of focused on cashing out. You think about cashing out. Your mind is on that, and you're looking for ways to do it. It doesn't strike me as very compatible with that other mindset of being totally focused on the excellence of your brainchild. I think in the end, he was a very good storyteller who got a lot of people to, throw money at him, especially SoftBank, Masayoshi Son at SoftBank. And I have to read a quote by Matt Levine. He said, Adam Newman figured out maybe the best and funniest way anyone has ever made money in the history of capitalism, which is act crazy around Masayoshi Son until money spews out of him. Figuring out how to rent out office space for more than you pay has absolutely nothing to do with it. That's where I am. I think Matt nailed it there, and it doesn't look good on Adam Newman. I can't imagine ever giving the guy a dime.
Yeah, wow, that's a really good way of putting it. Sometimes, you just need to find the right person who's willing to give you, whatever you ask for. What you're talking about, it reminds me of for like smaller entrepreneurs too, or, smaller sized companies. Like, if you ever watch Shark Tank, if they get a whiff of the idea that these entrepreneurs just all they're there to do is build the company and cash out, like at a certain point, like if it's part of their pitch, like, oh yeah, we'd love to sell to so-and-so at some point, they get shot down every single time by these guys, usually. And it's because the same thing you're talking about. They don't want to be part of something that's just a vehicle, just to, like that's a stated goal is to cash out at the end. Like that's really it's not a great long-term, you don't become a successful business person over and over again by just trying to do that. You have to like focus on the product itself and selling. So
to be fair, I know people who seem really brilliant who talk about all their exits. They talk about the string of exits behind them that made them rich, and even muse about another 2 or 3 exits and I'll be done with all this or something. It's maybe not cut and dried, but that mentality of cashing out, I think we're on the same page. It's different than the one of building something great. So with that, maybe we'll move on to Jay Powell, who saw that winning streak for 8 days in the S&P 500 and said, that's enough of this.
Yeah, he brought back the speeches from six months ago or a year to say, hey, we still might raise rates some more. It's not all over yet.
Right. He was at what was it, an IMF event?
Yeah, IMF event. Didn't get the invite to that one. But yeah, another one of these speeches. I mean, usually, after the Fed meetings, they then have, he has press conference, obviously, but then like a week or so after that, all these Fed people go out and keep talking to clean up or clarify any messages that they want to get out there. And so maybe this was a little bit of that, pumping the brakes on the we might be done hiking rates tone that I took from it. I know you thought it was a little more hawkish the last time, but I think cooling the jets on with the bond market doing what it did and then stocks responding in kind, like I think he, if he said anything different, it might have been kept that going. So
right. So his talk is up on the website for the Federal Reserve, federalreserve.gov, under the news events and things. And There was one particular couple of sentences that are getting quoted in the media. So let me just read that. He says, the Federal Open Market Committee is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. We are not confident that we have achieved such a stance. We know that ongoing progress toward our 2% goal is not assured. Inflation has given us a few head fakes. If it becomes appropriate to tighten policy further, we will not hesitate to do so. I don't think stocks liked that.
No, you saw a pause in the rise, from over the last 2 weeks, but it's so interesting, like, literally last week he said, "We think policy is at a sufficient enough restrictive stance."
Yeah.
Like, he literally said that just the opposite. Now a week later, he's not as confident. So, I mean, make of that what you will, but that's typical
Yeah.
Fed speak, I would say.
So, okay, let's give J Powell the benefit of the doubt and try to interpret. Maybe sufficiently restrictive meant we're not hiking right now. We don't see another hike real soon. And then this week he wanted to make sure that everyone knew there could be more hikes. We really are. In other words, maybe the waffling is him trying to convince everyone that they really are kind of data driven, such as the data is. We all, it's this backward looking stream of data that they look at. And that it's almost like he wanted to say, no, you don't understand. We mean it. We really will hike again if we think it's the right thing to do. Whereas everyone wants to look for hikes are done, cuts are not far away. That has been the impulse since the beginning. Oh, they'll do this and then they'll cut. They'll do this and then they'll cut. They'll do, and it's just gone on and on and on like that. And you can see stocks rallying every now and then, with that expectation. But believe me, if you believe that he's sort of as weak as his predecessors and still really dovish inside and still really not wanting to, break everything, I could see the argument for that, but so far he's looking to me like he would rather be thought of as the guy who absolutely positively did not let inflation get out of control and made that his priority rather than not breaking things too badly.
Yeah, those are good points there. I mean, I think part of it might be, maybe he wants to prime the thinking that, okay, we can still have another small rate hike in December, which is what the committee had projected the last time around, I think like a month or two ago, that they would still have one more. Because the way he was sounding the last month or so, made it sound like they're leaning toward not doing anything. But I think yesterday it sounded a lot like, okay, we could still be doing something. And then I think if he said anything different, as I said before, market would have kept going higher. And I don't know if that's exactly what they wanted to see with and bond. They might have seen bond yields going even lower, which I think he might have not wanted to see, given the part that you mentioned last week about financial conditions tightening that they inserted into their little statement there about contributing to a restrictive economy. So yeah, I find myself trying to not fall into the trap of what you're saying too, like, oh, they're just going to cut whenever something goes wrong. I think there's a difference between that and holding rates where they are for a long period of time, which is what I think is going to happen as long as they can next year. And it may be all of next year. It may be, who knows? I don't know. It may be 2 years. I don't know. They may raise rates again if something happens that spikes inflation again. But right now, I think there's a difference between that like stance and, oh, they're going to cut in like March, immediately if something goes wrong.
Right, there is. I think, and that's like the mindset that I'm talking about in the market. It's like what you're talking about is kind of not appreciated enough. That mindset is not popular enough, I don't think yet. And the basic one of expecting cuts still is. But also, there was a little clip like Jay Powell got caught dropping an F bomb on a hot mic telling somebody to close the effing door. Did you see that?
No, I missed that. Oh, damn.
Yeah, I don't know if
I missed that.
Yeah, I know. I don't know if it's real though, because these things can be doctored up, and people have doctored up, Jerome Powell to say the most hilarious, profane things on social media, and I just there was something about it that caught me as it's quite possible, but I haven't heard anything otherwise. I was just wondering if you'd heard it. It was
I had
funny
not, but
because
when we get done here, I'm going to look it up.
yeah, it was a climate protester was in the audience, and it was this woman who was started yelling out things about the climate or something, and they were taking a break, so he just kind of stopped talking, walked away from the podium, and apparently walked through like a stage door or something. He said, "Yeah, just close the door. Just close the effing door, man." I was just like, "Oh wow, okay."
Might be a
But
few memes out there about that one.
because if anybody, these Fed people, they come off as very staid, well-behaved conservative people. And I don't know if Bernanke or Yellen or anybody's been caught on a hot mic like that. Probably
Yeah,
not
hot
important.
mics are always fun. Hot
Yes.
mics are they are important. Hot mic moments are always important because they actually show you what a person's really thinking.
Yeah. Okay. Well, with that, let's get a hot mic in front of our guest, Marc Chaikin. We've had Marc on the program before. He has been around Wall Street for decades and decades. He's been there and done that. He's created indicators. There's stuff on your Bloomberg terminal that bears his name. He's been there, done that. He's a very wise guy and has a lot of wisdom to offer investors about trading and investing and just markets in general. And I'm sure that you'll hear lots of it today. Get your pen and paper out and take notes, write this stuff down. So let's do that. Let's talk with Marc Chaikin. Let's do it right now. The Fed wants you to believe they've got inflation under control, but I believe we've only seen the beginning of a devastating new crisis. And if you don't prepare now, you could see your savings evaporate as inflation and interest rates soar even higher over the next 2 years. It all traces back to a golden thread that ties together the biggest financial calamities in America's history. But it seems the entire financial world is falling into this very same denial trap that led to massive devastation the last time this crisis played out. If you know your history, you know there will be winners and losers, and now is when you decide which one you'll be. I've spelled it all out in an urgent new report. Go to www.bankrun2023.com to get your free copy. I'll also show you how to get my complete playbook for navigating this crisis, including the 3 critical steps to take immediately. Again, that's www.bankrun2023.com for your free copy of my new report. Marc, welcome back to the show. Nice to see you again.
Dan, it's good to be with you.
And I have my co-host, Corey McLaughlin, with me today as well.
Marc, how are you?
I'm good, Corey. Sorry I missed you at the recent conference, but we'll do it again sometime.
Yes. Look forward to seeing you at the next one.
Yeah, it's just not a party without Marc Chaikin, I have to say.
Ooh, I was partying in Italy. It's a love affair with Amarone.
All right, sounds good to me.
Talk about better to be lucky than good. After we left Tuscany, which was sort of the last few days of October, the rains just came down in epic proportion. And I don't know what people did in those towns where we were, which was Lucca and Milan, just unbelievable.
Well, lucky you.
Yeah, I'd probably still be there.
So I think we should probably reorient our listener about the power gauge, which is this really quite incredible tool that you've created. And let's just tell them what it is and what it does.
A good place to start. The power gauge is a 20-factor model that I built after the financial collapse of 2008, because I felt that individual investors were of a mind to take back control of their own portfolios. And I just felt that they didn't have the tools or the temperament to manage serious amounts of money. And in fact, that's what happened. So what I set out to do was to build on my experience with my institutional brokerage clients in the 80s and 90s and sort of synthesize what they looked at every day, primarily from a fundamental point of view. My background was really in technical analysis, but I had dabbled with fundamentals and things like industry group relative strength, which is sort of a hybrid between macroeconomics and technicals. And I was successful after about a year plus of research in building a 20-factor model that's what I call eclectic. It's not a value model, it's not a growth or momentum or a dividend model. And it does a really good job of identifying stocks that are likely to outperform the market over the next 6 to 9 months, or more importantly, stocks to avoid because they're likely to take a hit. So that's the background, and we've had a series of products built on the power gauge, and since we're part of the MarketWise umbrella, we've really upped our ante, so to speak, and we're impacting a lot of people, and the response we're getting is very positive.
Yeah, I've heard nothing but good things about the power gauge. What interested me about it, the first time you and I ever spoke about it, was what a good tool it is for timing these, like you said, those 6-month trades or so, and the fact that it's got so much fundamental input. Because, fundamentals are generally viewed as not good timing tools at all, but you have a timing tool that does incorporate fundamentals. I found that fascinating.
Well, there's a timing element within the power gauge, but it's only 15% of the model, and that's our technical component. But we also bring in relative strength and Chaikin money flow, which are part of the 20-factor model, but also exist sort of as standalone technical indicators. So what I like to say is, no matter how good your fundamental research is or your quant model, if the market doesn't agree with you, guess who wins? The market always wins.
Yes.
And so no matter what the power gauge is saying, if it's bullish on a stock, but the stock is not outperforming the market, and we've sort of taken a mathematical formula and converted it into a red-green, very easy to interpret indicator, then you're just investing in what I call dead money, where you really get alpha or serious outperformance is when the market agrees with the model. And that's where the timing element comes in. So if you've got a stock that has bullish underlying fundamentals that's sort of underperforming the market, it's telling you that the big institutional money is not there yet. It's when that money comes in that it typically starts outperforming the market, and then you can get multi-month moves. So just to give you one example of that right now in the cybersecurity space is CrowdStrike, CRWD. The stock has been outperforming now for 9 months with a bullish power gauge rating, and it just keeps going on to make new 52-week highs. Same with Microsoft, interestingly. So it's not just sort of out there tech stocks. It can work in a stock like Microsoft, where it's just pointed us in the right direction and keeps going up and making new highs.
Yeah, I'm just looking at a quick chart of CRWD. And from about, it was like 95 in January. I don't know when you guys picked it. And it's about 192 now.
Right.
Not bad.
And they say it's better to be lucky than good, but, sometimes if you just got the odds in your favor, you can really ride a crest, and that's what's happening. It's also happening in Adobe, by the way.
Oh, Adobe?
We turned bullish on Adobe last November, so a year ago, and Adobe is, again, talk about a little bit of luck. They really have done a great job incorporating AI into their software. And so the initial wave in Adobe was based on fundamentals and an acquisition that they were making. But the second wave, as it stayed bullish this whole time, is, I think, based on the enhancements to their product suite with AI. And so these are examples of stocks where it's not just a 6-month trade, but where the power gauge gets you into something and then the market sort of takes over. And some of these positions can turn out to be big winners. And you notice these are not in the small cap space.
No.
It also works, but it works on steroids.
So I'm looking at the Adobe chart, and just really roughly, I don't know what your guys' price was, but just say around 330 or 340 or something like that in November, and it's 587 now. So
exactly, and
you nailed that one.
I look at point and figure charts sometimes to get targets, and the point and figure target on Adobe is slightly north of 700. So, which interestingly, once you get up into these telephone book numbers, in the old days they split stocks, so we don't see very many stock splits anymore, as you know. But that's only a 20% move. Think about it. You get from 580 to 700, and it's really just a 20% move.
Right.
Entirely possible if we're back into a bull phase, which I think is where we are right now.
Yes, there's no denying that 2023 has been, let's just say, really hard on the bears. Despite some recent action, even since July or whatever, just overall, it's been rough on the bears.
Well, again, it depends what you're bearish on. If a lot of these folks were bearish on tech because of interest rates and the potential for PE ratios to compress, and that hasn't worked out particularly well.
Right. Lots of folks talking about a recession next year, Mark. Do you care?
Of course I care, but I'm just not smart enough to know what constitutes a recession anymore. When I started out in Wall Street, I was very fundamentally oriented, and the one group that I always avoided were economists. They used to say if you laid all the economists in the world end to end, they still wouldn't reach a conclusion.
Yes,
you've said that before, Dan.
Yeah. Really? Oh, cool.
Yeah, I mean, all the world's economists laid end to end.
It may be that we've been in a series of rolling recessions in various sectors of the economy. I think, and we'll only know this in retrospect, I really believe that it's a different market. And that's, John Templeton said that's the most dangerous thing you can say in Wall Street. It's going to be, this time it's different. But because of technology, I think that we're seeing productivity enhancements that sort of defy description based on the old concept of a manufacturing economy going into a recession or consumers stopping spending, which is always possible. But we're in such an incredible time, and AI is just one manifestation of that, but it's a big one, that productivity enhancements could mean that we've already seen the recession and we're now in a rolling recovery. I just don't know, which is why I like to rely on things like momentum trends and the power gauge, because I'm just not smart enough to know about a recession. And by the way, people have been talking about a recession now for over 12 months. So,
oh yeah,
stop clock is right twice a day.
Yeah, that's right. I stopped talking about it some time ago because I realized I was never going to get it right. So, I mean, we'll have one sooner or later because we always do. But you won't catch me trying to predict it anymore.
Yeah. What do you think about the notion that maybe, we really are in a different world with 24/7 information runs on the banks, possible with just your iPhone, and productivity just going off the charts in terms of software enhancements and so forth?
I probably don't think that anything is terribly different. I think we do live very differently, and we will continue to do so. And I also think, AI is software, and it will enhance every piece of software that it can possibly enhance on the face of the earth. It's Internet 2.0 is really what AI is, right? That is not another version of the internet, but the next gigantic, absolutely pervasive, all-consuming innovation. Software ate the world, well, AI is going to eat software. And I have no trouble believing that.
Yeah, I agree. I'd call it the icing on the cake. Of course, between the internet and AI, you had cloud computing, and that's really the glue that ties this together. That's the DNA thread, and that's where AI comes in, because you've got all these data analytics companies using the cloud and people moving their software into the cloud, and that's where AI is so applicable. So interestingly, just to give a little historical perspective, back in the aughts, when I was quote unquote retired, I got interested in neural networks and artificial intelligence. And the chips to do that were just off the charts expensive. You needed Cray type supercomputers. And then I found a company called NVIDIA, and they were using something called GPUs, graphical processing units. And I could have bought a GPU that's the equivalent of all the computers at IBM for about $8,000 or $9,000 in 2003, but there was no software that it could run on. In other words,
Right.
you had the computing power, but you didn't have the software. Now you have both. And I think that's where this whole convergence of technology, data, and machine learning comes in. And I think it's going to unleash unbelievable advances in medicine, in data analytics for retail and so forth, and self-driving cars eventually, because that's what you need to get this sort of next generation of enhancements into the marketplace.
Yeah, I have no trouble believing that. My current view, though, overall about whether or not the market is different this time, is really ruled these days by this idea that I've got a hold of, that we just don't realize how much 0% and very low interest rates for that long, let's just say starting in 2008, but you could argue before that, but at least since 2008, I don't think anybody knows how much we don't know about how pervasive the effects of that were and how it got into absolutely every nook and cranny, financial, economic, and otherwise, of our world. I think we're going to learn that.
And we're starting to see some of that in the marketplace. Companies that took advantage of zero interest rates to float shorter term debt that's now going to have to be rolled over are in a tough position. That's why one of the factors in the power gauge is debt equity ratio. And another one is return on equity. So if you just screen the universe of stocks and eliminated companies with very high debt equity ratios and low return on equity, you'd eliminate a lot of the problems that you're going to experience going forward. So I agree with you 100%. The question is there a ticking time bomb like the credit default swaps in 2008, which is going to result in a big sort of existential moment for the financial markets? Or have analysts sort of factored all this into their earnings forecasts and their projections? Not in every case, but in some cases.
Right. And I don't know, maybe I'm too much on the short-term action here, but with yields, rates and yields rising as fast as they did and then kind of bouncing off 5% lately, and with small caps behaving as horrendously as they have, I mean, those small companies employ half the country, even though the market cap of it is like less than 10%, they employ half the country. And it concerns me. And I think there's certainly like trading opportunities there on both sides, but there are reasons to be cautious. But I agree. Look, guys like us wind up on the same page. We worry in big ideas and we invest from the bottom up, And so many guests who have had a lot of success over a long time, they do the same thing. Everybody worries top down and invests bottom up. They have their system, they stick to it. They worry. You and I are worrying aloud about these things, but you're not going to go home and say, the power gauge is going to stop working any second, so I'm going to stop using it. You're not going to do that, right? That would be foolish.
Yeah, and actually, you've just described a methodology that is near and dear to my heart. The only modification I would make is that industry group relative strength is really a macro economic representation of what the investment world is seeing and thinking. And so I like to do top down in terms of finding the strongest industry groups based on the power gauge, interestingly, and then bottom up to find the strongest stocks within those groups based on the power gauge. And that's what got me to Adobe and Microsoft and the home builders for a very big run, earlier in the year. So I think we're talking about a very similar process, but I like to filter my universe down to the strongest industry groups on both a technical and a fundamental basis. And the power gauge ratings for industry groups and sectors accomplish that pretty easily.
Hey, Mark, that gets me to a question that was just on my mind. You're mentioning top down, bottom up. I think the last time you were here with us earlier in the year that you mentioned, you had just turned bullish, I believe, or maybe a couple of months before that. Just curious what your general outlook is now. You mentioned you think we're in a bull phase here, but what do you see kind of generally now?
I think that we're going to rally into year end and maybe a little bit more. And then we have to see what earnings estimates look like. But we just had a breadth thrust in the market. It was coined and researched by Marty Zweig a long time ago, back in the 70s. So it stood the test of time. And it's similar in a sense to the breadth thrust that we had in January, which is part of what convinced me that the bottom had been seen. And that breadth thrust was basically the 5 days through Friday, November 4th or 3rd. And we've seen a continuation of that, which is surprising a lot of people. So you've seen short-term strength on top of the breadth thrust. And typically in a pre-election year, the market is very strong into year end. And interestingly, I was looking for a V-shaped bottom in October. It came later than I expected, but nothing's ever perfect in the market. So you've got a lot of people who are looking for a retest of the lows. And here's an interesting way to look at the market that I don't think you'll hear anybody else talking about. Equal weighted S&P. So everybody's focused on the magnificent seven mega cap stocks that they claim are driving this whole market. And to an extent, they're right. But if you look at the RSP, which is the equal weighted ETF that monitors the S&P, it was down about 15 or 16% when we made the low a week ago in the cap weighted S&P. So you could argue that there's been a correction going on all year in the 493 stocks that are not in the headlines every day. And interestingly, the RSP, using a weekly time framework, reached an extreme oversold level in my work that's associated with bear market lows. So you could argue, as Dan pointed out, small caps have been in a bear market. It's been ugly. And you could argue that the other 493 stocks in the S&P have in the main been in a bear market. So pretty tough to put labels on a market that's that bifurcated. But I do think we're going to rally into year end. My initial target of 4,600 was reached in late July. I thought maybe we could extend out, but I'd be thrilled if we're back at 4,600 at the end of the year.
From below 4,400, where we're talking right now.
Exactly. And 4,400 is a sticking point on the upside because it's the previous rally peak. And so we've got to get through that. But if we do, and remember, we've got a dysfunctional Congress, and so we've got a budget crisis coming up. So nothing is straight up anymore for sure. So there could be some choppy action around Thanksgiving when that whole budget debate gets heated up again. But we always get through those, and I think we will this time.
You think we'll agree to spend more money again? Everybody will agree to spend more money again?
We always spend more money. That's the way of the world. They used to say you didn't want to be invested in the stock market in a year when there was a budget surplus. I don't know if that applies any. We're hooked on deficit spending. Is that good for our grandkids? No, but it's just a fact of life.
Yep. And I'm just going to guess that if the three of us got together and worked very, very hard, we couldn't change it if we spent every minute of the rest of our lives trying to. So.
Exactly. Times 100. I don't know how you do it. And that's really the conundrum in the market. Interest rates at 5% put a real strain on the budget deficit, because the cost of servicing the debt is so high. And to be fair, I don't think the stock market can stand up on two legs with interest rates above 5% on the 10 years. So to me, bouncing off 5% was a really big deal, because above 5%, I think you do have effects at the top line and the bottom line that are not pretty. So I'm very hopeful, and for a whole series of reasons, that 5% is the likely ceiling, in which case, I think a bullish outlook is justified.
So it sounds like it would bother you if we steepened, if the curve steepened from here, as it has been for a little bit. I mean, in other words, we inverted, yield curve inverted, and now it's appears to be in the process of uninverting, reverting. I'm not sure what the right word is.
Reverting. Yeah, there's an interesting indicator. Goldman Sachs has a financial conditions indicator, and it's really good at measuring market psychology, actual bond prices, and other variables. And it peaked initially, or it bottomed out on the end of July, and it was in a straight up trend, which means financial conditions were tightening up until a week and a half ago, and then it just plummeted. So, there are a lot of variables in this equation. Some of them are psychological, what's the Fed saying versus what they're doing. Some of them are real, but what encourages me is that mortgage rates drop so quickly. And obviously, home building is critical to the growth of the economy, and we need to get on with that for all these people who are in the marketplace for homes but can't afford them right now.
Yeah, I saw affordability. It was basically at something like, I think it was like 2005 or 2006 levels or worse.
Yet real estate still seems, the market still seems so tight. Like I just, it's very local, but
yeah.
I had a neighbor, their house was on the market for less than a day the other day. Like it was, because of that supply, I guess, that long-term trend we've been talking about for a while.
Well, there's no inventory, and anybody who's got a 3% mortgage is going to be pretty reluctant to sell that house and then buy something new at a 6% mortgage or more. It's crazy what that does to your monthly cash flow. So, yeah, there's no supply to speak of, and houses get gobbled up, which is why the home builders have to continue to plow forward and hope that interest rates drop, and that the demand is there. Clearly, there are millennials who are in the marketplace for homes, but it's just hard to afford them right now.
Yeah, that late October bottom you mentioned, which was peak in financial conditions, like just looking at DR Horton, it's up like 21% from there. Just snapped right back 20%.
Like a rubber band. Lennar as well. Those are my two favorites in the group, and because the power gauge is bullish on both.
So what do you think would happen to certain companies or the market if the 10-year went above 5%? Because I've seen some other people say, when inflation is this high, or above 2%, 3%, like it's been historically kind of before the last 15 years, it was normal for the 10-year to be above 5%, like 6, 7, something like that.
Good question. I would not like to see the 10-year above 5%. I think the stock market would react very badly to that. A combination of the algos, sort of hitting the market, demand pulling back, and PE ratios contracting. I mean, the interesting thing here is that third quarter earnings are at record levels. You'd never know it based on what people are saying, and part of that's productivity. But in the S&P 500, third quarter earnings are at record levels. Now, a lot of that are the Magnificent Seven stocks who are just cash flow machines, but it's a fact. So I just don't know that you can use analogs anymore because of so many different variables that are in the mix, like 24/7 access to your bank accounts, and the ability for the market, people to do what's called at-the-money offerings. I mean, companies can just sell into the marketplace when they need to raise capital if their stock is strong enough or not weak enough. So it's a different market to me. And, they say once the yield curve goes positive again, that you then get another leg down on the market. I don't know. Maybe.
Neither do I.
I don't think so, guys. I just don't. And I do think, though, that credit conditions are such that you could easily see the 10-year pull back to 425, and that would fuel a big year-end rally.
Yeah, you're not the only person talking that way at all. And, it certainly wouldn't be unusual.
They don't get the headlines, so that's what's interesting. We really have what I call a negative clickbait mentality, not just, in the Facebook and Google and Huffington Post world, but in the stock market. They just don't want to put optimists on TV because it's not controversial. So you don't get the bullish picture very often if you're watching CNBC. Maybe Dan Lee, or it's one bullish guy out of a whole crew of naysayers.
No kidding. I mean, for a long time, it was the opposite, wasn't it? I mean, for a long time, it was there. You were basically fired for a bullish view if you were a talking head,
right?
Or a bearish view. I mean,
a bearish view.
Yeah.
But now it's all about clicks. So clicks on the website. It's an interesting world we live in, and all the more reason that you need something like the power gauge to just sort of cut through the clutter. I mean, those were some of our original marketing messages. Just cut through the clutter and, solve the information overload problem with something that is reliable and not going to work all the time, but it's going to work over time. And that's been the case now for 12 years since it's been in the marketplace. So, yeah, there's so many conflicting views out there, and they get amplified. I mean, when you see there can be a negative pattern in the stock market that I studied 35 or 40 years ago. And now when it triggers, everybody's tweeting about it and blogging about it. So it's that's why I say it's instant access to information. And I just think you have to go with the tried and true when you're investing, and avoid the losers and back up the winners.
And there we are once again. I've been doing this since 2018, and we've interviewed, a couple hundred people, lots of traders, lots of folks like yourself who have been around for a while and seen a few things. And they often wind up right where you just said, tried and true, stick to your system, cut your losers, back up your winners. It's, the amount of times I've heard that, I wish we could keep a running count of the number of times we've heard this from different people. It just comes again and again. I feel like we're writing a market wizards book in real time with these interviews.
I was just going to refer to the market wizards. Jack Schwager nailed it in the first one. Every one of those people that he featured in the first book had a system. They were all different, and they stuck to it, and they implement it every day, day in and day out. And that's how you make money on Wall Street. Not going to be right all the time. You're going to have some rough years, but you've just got to believe in what you're doing, and every day just implement that strategy.
Right. Your system has to work in the first place. It's got to be worth doing, but once it is, trying to second guess it, it's disastrous. And Schweiger has those stories too.
Exactly. Well, someone once said, if you use the right money management scheme, risk management scheme, you could make money by flipping a coin in the market. And the right money management scheme is ride your winners and cut your losers. So, flip a coin, buy a stock. If it doesn't perform, get it out of your portfolio. If it keeps going up, then stay with it and maybe buy more on a pullback. But I mean, that's a little bit flip, but
no,
it works.
Right. It's only a teeny bit flip, Mark, because you and I both know that it's, people are obsessed with the entry. Everyone's obsessed with the entry. Few people talk enough about the exit, and nobody seems to talk about, risk control and position sizing and all the rest of it being more important than the entry, and just the discipline to stick to that like glue.
Have you ever read those books on risk control? There's a guy named Van Tharp, who I think was actually involved with Porter
early on,
back in the 90s. And Van has written a fabulous book on risk control, and it's dry as dust. A friend of mine co-wrote it with him. Nobody reads that stuff.
No. Right. It's very hard to conceptualize in your own head. Yeah.
Yeah. Position sizing, so critical. You make outsized bets because you really believe in a story more so than some other bullish power gauge rating. It never works. Doesn't work for me, and I do it occasionally. I fall in love with a stock with a bullish power gauge and take too big a position relative to my capital, and it somehow never works.
There you go. Go ahead, Corey.
I was just going to say one thing about the power gauge that hit me when I first, a couple of years ago when I first saw it was, like you were mentioning CrowdStrike and Adobe and the bullish power gauge range, which, by the way, it's so simple. If nobody's tried it, it's so simple to follow this power gauge and make sense of it. But like you said, you have a rating on each stock, and that we could infer, and people will infer, any sort of in the market will make any kind of reason up for why a stock is performing the way it is. But this really just breaks it down to, the numbers, which is, at the end of the day, if you're interested in making money, what you want. I remember like a couple of years ago when we were talking, I was just clicking through and there was a bullish power gauge rating on some Greek shipping company. And I was like, why is that the case? But then you could kind of connect some dots and make some sense of, inflation at the time and supply chain issues and all of that stuff. And so anyway, that power gauge is also useful just to look at what may be happening in the market and connecting it with the price action, I would say. I don't know if that was an intentional thing that, you did way back when, but that's what hit me when I first saw it.
Well, Corey, it all ties back to fundamentals. And, I like to say that fundamentals drive the market, but technicals drive the market to extremes. So you have to combine fundamentals and technicals. And the place where that really shows up is people who, persist in bottom fishing. And I hear this all the time with Disney. Well, isn't Disney a buy here? And I say, well, if you like bottom fishing, it is, but bottom fishing is probably the most expensive sport in America. Not something I've ever been good at, although I've tried it. I mean, a lot of this is, put your hand on the stove as a child and get burned and you'll never do it again. And so, a lot of what's in the power gauge is basically positive, but what it leads to is conclusions that sometimes go against what you'd like them to be. I mean, the Beyond Meat craze, you name it, it's going to happen in AI, with some of these overblown evaluations. But you just need a reality check. Just think of it, the power gauge as a reality check. And I think you've sort of nailed its usefulness.
I feel like we should tell the folks where they can find out more about the power gauge because we've mentioned it so many times. What's your website, Mark?
It's chaikinanalytics.com.
There you go. So chaikinanalytics.com. Sounds good. It's actually time for our final question, which you've answered before. I hope you forget it because it works best that way. And it's the same question for every guest, no matter what the topic, even if it's a non-financial topic, same final question. And that's simply, if you could leave our listeners with a single thought today, what would it be? And if you've already said it, feel free to repeat it.
No, I'm going to go in a different direction. Love thy neighbor and dialogue. We're in a really tough time in America right now where everything is so polarized. And no matter how much money you make in the market, if you can't have a Thanksgiving dinner with discourse because people don't talk to each other in the same family, it's not worth it. So I'm going to go in a very holistic direction with that one.
Very good. Previous guests have taken a similar direction, but I don't think I've heard that one. Thank you for that. That was great. So, Mark, great to talk with you, as always. And I certainly hope we'll be doing so again soon.
It's always a pleasure. You guys are doing the investment community a real service because to get an in-depth airing of your ideas is unique in this sort of clickbait world. So thank you guys. Really appreciate it, Dan and Corey.
You bet. I'm sure you've had your share of experiences on TV where they give you like 2 seconds to talk and cut you off and everything else. I've had those experiences. They're not pleasant. I don't like them.
No. Even worse is going into New York and finding out that Fox has canceled you because there's a breaking news story. So,
right, yeah, you fought the traffic for an hour and now you're canceled. Yep.
Right.
All right, Mark.
Much better. Be well.
Thanks, Mark.
You too, sir. Thanks.
Thank you.
The man who predicted everything from the rise of inflation to the death of the 60/40 portfolio is stepping forward with the clearest and boldest prediction of his 4-decade career. It all boils down to a single stock, and it has nothing whatsoever to do with artificial intelligence. Former Goldman Sachs trader Dr. David Eifrig believes anybody confused by the current market conditions needs to hear his story immediately. Many of America's best-known investors already bought shares, including Paul Tudor Jones, New York Mets owner Steve Cohen, and Jim Simons, the man the Wall Street Journal named the world's best investor. People in the financial world know Doc Eifrig as the man who went on 3 separate winning streaks of over 100 winning trades in a row. But today, he's zeroing in on just one company and wants to hand you its name and ticker symbol at no cost. In fact, he believes every American should own this company, and soon. To get the full story free of charge, simply go to docprediction2023.com. Again, that's docprediction2023.com. Hey, it's always great to talk to Marc Chaikin. Before I say anything else, though, I want to say 2024prediction.com, 2024prediction.com. At that website, you can sign up for a presentation that Marc is not the main guy. The main guy on that is going to be our friend Greg Diamond, who's been on the show before. Great trader. Speaking of great traders, which we did during the interview, Greg has something very serious to talk about. When he gets a signal in his trading system, you know, he's like sending me emails and calling me up and texting me. It's intense. And I think he's got a big one to share in an upcoming presentation that you can sign up for at 2024prediction.com. But Corey, maybe I'll start with you and ask you what you got a takeaway for me?
I just love listening to Marc talk about the markets in general. Every time I listen to him or talk to him, you just feel like you're talking to some yogi of the markets, and you are really. I mean, he's been around for doing Wall Street and trading for like almost 60 years, I think. So he's seen it all, literally, and I think you could hear that from him. And some of the best traders just say, "I don't know why this would be happening, but I'm just going to manage my risk and move on."
Totally agree. Completely agree that is the takeaway. It's like every sentence that comes out of his mouth, he could say at the same time, he could say, "I've been there and done that. Listen to me, please." And then, he drops another nugget of wisdom. And believe me, if you can do it, Marc has probably done it or seen it done right next to him with, one result or another over the years. And you can just hear it in his voice as well as the logic of his words. When he says, "I just stick to my system," and then he'll say, like you say, "I don't know." People are afraid to say they don't know in this world, especially when you put a microphone in front of them and say, "This person is important, listen to them." They feel they don't want to say, "I don't know." But people who've been there and done that, like Marc, say, "I don't know," all the time. So I agree with you. And it's funny because there's certainly a lot of that type of wisdom in print, and the impact isn't always necessarily as great as sexier sounding stuff like "buy this now, sell this now," et cetera, et cetera. But it's more important and it's more valuable. We got to find a way to make Marc Chaikin sexy, man.
Wow. I don't know if I can do that one, but he does know what he's talking about for sure. And I will say just about his, you mentioned his, him and Greg's video event coming up. I know, Greg obviously comes at it from a technical analysis perspective. And, a lot of times his views align with Marc's views. I don't know if that's exactly the case this time, but I'm curious to hear if that's the case. And so I always say, like, when I see different people who know what they're talking about and their views align at the same time, like, that's a time to pay attention and at least hear them out. So
yeah, when a guy like Greg and a guy like Marc agree, I just knee-jerk throw a little something at the trade right away. I don't even think about it because, and it's a little something, right? Just you don't want to knee-jerk serious money. A little something meaning what I can afford to lose. But when those two are on the same page, because they both have great tools and they're completely different tools, and then when they line up, you're like, whoa. But yeah, I enjoyed that as always. I mean, when I talk to Mark, it's just sort of he's one of those people you got to talk to the same way you need to read good books over and over.
Yeah, I always feel better after listening to him talk about the markets. He speaks with just such a confidence and just an easiness about it all. So I'm glad I was in on this one.
Yep, he's avuncular. All right, well, that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com, please. And also, do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, until next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.